Good morning. On behalf of everyone at Coker James, we hope you had a wonderful Thanksgiving and are looking forward to the upcoming holiday season and New Year. I'm Joe James, one of the founders of Coker James, currently serving as CEO and Managing Principal. Joining me today are Donna Briggs, CFO and a principal at Coker James, and Scott Wallach, a financial planning consultant with our strategic wealth management and financial planning partner, HK Financial Services. Our focus for today's webinar is the year-end planning, and we have several topics of interest to share with you. One of the things we hope to convey throughout our short time together is how integrated personal financial planning, business tax planning, and individual tax planning are. You see, at Coker James, we've partnered with HK Financial Services in order to do just that. Holistically bring together these planning strategies to your CPA and HKFS financial planning consultant, who are on the same team working on the same strategies for you. So with that, thank you for joining us today. Now let's get started. We'll begin with addressing two of the most common items we're hearing from clients. Should I accelerate income into 2020? And update me on the PPP loan situation and ever-changing guidelines. Donna and Scott, would you please address these for us?
Sure. Thank you, Joe. Wow. Ordinarily, I would never entertain the question, should I accelerate income into a year? Because that just goes against everything we usually do. But I think there's a great deal of interest in the fact that we have a change in the White House coming, and we are still uncertain about the control of the Senate, which may temper any change a little. So people are clamoring to figure out, are tax rates really going to increase soon and fast? And that causes anxiety. People want to maybe accelerate something into this year. The answer is it depends. I really encourage people not to just blindly go into doing that. It is imperative that there's a good comprehensive plan that goes from year to year to year, maybe even a 3-year plan, so that you can sort of anticipate increased tax rates and maybe even some changes in deductions we see, and versus time value of money and what you would do with that money if you could defer paying those taxes into the next couple of years. So big loaded question, but it just means if you have the ability and opportunity to be asking those questions, the answer is you need a tax plan, and you need to do that as soon as possible. And it's not only tax rates and an income acceleration, but really, there's also a great deal of planning to do from a timing standpoint with even itemized deductions, because as you're aware, as an individual, the standard deduction is pretty high. A lot of people find themselves in a situation where they can't itemize in a normal year. And with some creative planning, maybe bunching things into years, you can get the most out of those high standard deductions and save up for a year to really appreciate some itemized deductions. So income and deductions, they just require planning, and I think timing is everything on those. Especially when we're bunching up deductions, or one thing that's totally in our control is charitable giving. I know, Scott, you do a lot of planning in this area. It's something really fun to work with clients on, because people that have a giving heart, to be able to just plan and leverage that is a really, really great vehicle.
Yeah, absolutely, Donna. It's a huge time of year, and people, obviously, the holiday season are cheerful and in giving mode and everything too. And it's a very common conversation that I'm having with folks this time of year. A lot of people think I can just give money to charity. There's a lot of other strategies around it as well too, and we'll just talk about those briefly today as we have a little bit of time left in the year. And as you mentioned, Donna, kind of looking at the tax situation of a client, and getting into a standard versus itemized. Well, charitables fall into itemized deductions. We want to make sure that if you're going to really embark on a charitable strategy, that A, you accomplish your goals, and then also B, that you accomplish a tax reduction as well too. There's always a two-part conversation there. And looking at that, some folks say, Scott, I just like to usually just give to charity. What should I do, or what else can I do if I've had a higher tax year? And the question is, or the answer is what Donna said, is we can bunch 2 years into one. So normally, if you give a certain amount to charity every year, if you say, hey, I'm going to double that this year, that's an opportunity to do that, because potentially next year you might say, hey, I have a different year coming at me. My tax situation may be different. So we call that bunching charitable contributions together. Well, you can bunch them together and give them all to charity at once. Or you can also look at different techniques, such as a donor advised fund. That's a strategy very similar to a foundation that people would set up many years ago. The donor advised is a simplified version of that. You can fund your total amount of charitable contributions into that vehicle, get the whole deduction for the year, and then also sprinkle those out over a number of years as well too to various charities. And clients like that, because if something changes, for example, in the organization, the philosophy, leadership, whatever it may be, they may not want to have all that money go just directly to them. Go directly to them all at one swoop there. So at the end of the day, it's a great planning strategy there to look at those. So we have some time left in the year. Definitely think about, if you have a charitable plan, those that have had higher income years, definitely a good way to get money to charities versus paying it to taxes, quite frankly. Looking at another common question I get to at the end of the year is, Scott, what else can I do? I've got a tax. I know I'm going to have a bigger taxable bill this year. Retirement plans are a last minute hurry up offense there for those that are football fans. We can look at that and say, where are you at first of all, personally? Have you hit the maximum deferral rates in your 401k plan, if that's what you have at your company? That being said, that'd be $19,500 for those that are under age 50, $26,000 for those that are over age 50. If you turned age 50 this year, at any point in the year, you can hit that $26,000 mark. A lot of times there's some confusion around that. So make sure that if you look at your pay stub, pull that right up as soon as you can. Take a look at where you're at year to date. You could accelerate and increase contributions through the end of the year. If you're a business owner, do a bonus check to yourself and gross yourself up to get to that point. Again, as a business owner, just to keep going on that piece for a second, you can actually look at profit sharing in your company as well too. There's an opportunity to increase funding in there, and that is also a tax deduction that will flow through in 2020 for you. The good news is, on those profit sharing contributions, that's an employer contribution. That can be done all the way up to the filing of your income tax return next year. So if that's in April or September, October, you have time to finish funding, and that does not have to be done by the end of the year. So just know, after the end of the year, you can still use retirement plan as a vehicle to really help offset your tax liability there. So again, charitables, retirement plans, really one of the last couple of things we have left heading into the year to really look at some things there. But I'm going to say the three letters to Donna now. The common conversation we've had all year long is PPP loans. And again, probably going to look back at and say, hey, it was a good tool to have to really keep the economy going during the shutdown earlier this year. But Donna, I know there's some tax, confusion around that.
Yes, Scott. Why are all my questions the ones with great deal of uncertainty?
Yeah.
Wow, the PPP loan landscape has just changed weekly, basically all year long, and this is no different. You are all aware, when we got those loans and were qualified for forgiveness, Congress was very clear in saying that money was not going to be taxable, and that still is the way it's going to be treated. The interesting part is that when the IRS started interpreting how this would work, the actual tax rule of thumb is that if you have tax exempt income, the expenses related to it are not deductible. Therefore, they are saying that the wages you paid with that PPP money are not going to be deductible. Congress has clearly said that's not their intent. But this is something that literally takes an act of Congress to fix. We wait with a great deal of anticipation for January, February, and we hope a secondary stimulus bill or a bill that will actually just fix this gets through Congress. And, we're still extremely hopeful that that's the case and that this is put to bed. But to, add insult to injury, right before Thanksgiving, the IRS said, not only are the wages not going to be deductible under the current law, that the wages are not going to be deductible in 2020, even if you apply and get your forgiveness in 2021. If you have a reasonable expectation this is going to be forgiven, they've drawn a very clear line that it's a 2020 issue. So there's not a lot of playing with the timing, and it's really outside our control. We're waiting on a congressional bill that would actually solve this question. That bill will not come before December 31st. So the obvious no-brainer is when we're dealing with tax planning for our business clients, we're looking at two scenarios. We're looking at our expectation at high hope that the PPP money is all tax exempt and the wages are deductible. And we're looking at a secondary projection that gives people a word of caution. You may need to earmark some money until we know in the spring how this is going to play out. So it still changes. And I think this story is not going to end until the spring. So that's just something that's leaving small business owners a little stressed out and confused. And, you know, our classic things we deal with for small business owners are things like, should I buy equipment? You know, what should I do at the end of the year to manage my cash basis income statement? Well, you still want to do all those things. That's still the right thinking. The bonus depreciation is still around in 20 and 21. The Section 179 deduction is still alive and well. Now, some of those things are elective. So if you buy the equipment and you choose to make those purchases and the PPP results change your planning, some of those things you can elect to do or not to do after the year end with some of those expenditures. So I think the classic models for businesses are still paramount. You know, manage cash basis income, buy the things you need to buy, and you know, plan for crazy contingencies after the end of the year. You never before have we had so many uncertainties, and that's just so 2020. Scott, you know, I know that a lot of times we just get these tunnel vision at the end of the year about, let's focus on our tax return. Where are we landing? What do we do? But there's really also a really integral part of our overall financial planning that needs to be considered in this. And I love the phrase you've coined here, business tax planning. And then we go into financial tax planning. It's all integrated, Scott. How does the tax planning landscape pair with financial planning?
Yeah, it definitely pairs in there, Donna. That's for sure. It is. I like the word integrated that you stated there. It is very integrated, but it's also, as we've said in prior conversations too, I always want to let the tax dog wave the whole strategy here as well too. So looking at those components there. One thing that's really come up this year, and I think I actually had some conversations here over the last week or so, and some people still are being surprised by this. Those that have required minimum distributions out of retirement accounts, be it IRAs or inherited IRAs, that was waived this year. Again, 2020 being a unique year, as Donna said. Those R&Ds don't have to be taken this year. So the good news is if you don't need it and you have possibly a higher tax year this year, consider not taking it and not having that. So you may be hearing from advisors or other folks you work with there too that, hey, you want to take it or not. Most clients I work with have already made their decision and said, hey, I'm done. I don't want to take it this year. Now, with that said, you can take it this year as well too if you'd like. And if you have a really low tax year, might make some sense to consider taking it now after the markets have recovered from early in the year. So that's been a lot of kind of common questions I've received here at the end of the year is, what should we do? Now, if you don't take the required minimum distribution and you might say, I don't really need the cash anyway, a lot of folks are saying, hey, Scott, what about Roth IRAs? Could I consider moving money from my IRA to a Roth IRA? And that term is called a Roth conversion. And that is a viable strategy that still can be done at this point. Just know that when you move money from an IRA to a Roth IRA, it is a taxable event. Every dollar is taxed at your highest ordinary tax rates. But for some people, that may make sense to consider doing that. Why would you do that? First of all, a lot of people like moving money into the Roth to say if tax rates are higher in the future, I've now saved myself, I don't have any more tax due on that money in the future if I need it. If you don't need it, it'll go to your heirs as well too, tax-free. So a lot of clients like kind of looking at that current / future picture there and saying, hey, I could really take advantage of some things since I was given a kind of a free pass, if you will, this year on my IRA distribution. So just some things to really think about there when it comes to your retirement assets. The other thing, the last big one we're getting a lot of conversation about is capital gains and or capital losses. Early in the year, when the markets were moving around, personally, what we did for clients is just did a lot of what we call tax loss harvesting. Sounds kind of weird when you say that term, but basically what you're doing is selling positions, selling stocks or bonds that may be down at a given point in the year, recognizing a capital loss. But the good news is going right back into those markets and not staying out, especially if it's a long-term strategy for you. So a lot of clients, as we sit right now, look at their statements in December and in November here and say, hey, I'm actually doing well this year. It's been good recovery, much better than what it was earlier. We're all feeling a little better now as we head into the end of the year. But I also have tax deductions out there via those capital losses. So a lot of clients like having those because they might have some gains from other things that happened during the year. We have some clients that sold businesses this year, so they're able to offset some of those capital gains. The other thing that'll be coming to a lot of people, and you don't see this typically until later in the new year when you get your statements, capital gain distributions will be coming out of your, if you have mutual funds in your accounts too. Those are all happening throughout the month of December. So if we have those losses on the books, guess what? We just kept your tax return from showing a little bit less income than would normally be on there for you. So we call that tax smart investing. A big part of what we do here. That's why we are integrated as a team. Got to make sure we can maximize tax efficiency as possible for your investment planning as well too. So I love the term financial tax planning there. As Donna said, very integrated, Donna. I can't agree with you enough there.
Scott, so my takeaway here is just so clear. Individual tax planning, business tax planning, financial tax planning, and then you add a dose of complete uncertainty about laws and rates and increases in the future. It is a recipe for planners, and planners are really winning in that situation. It's just so imperative that your CPA and your financial advisor are working together on your whole situation, your long-term plan, and then your short-term timing. And all these things are just interrelated. The decisions about them are not independent, and they all work in harmony with one another. And that is just the thing that can add the most value to your situation, is just having that cohesive team that's planning.
Donna and Scott, as always, thanks for sharing this timely information with our audience. We covered many topics: required minimum distributions, PPP loans, itemized deduction planning. In concluding, I trust we've illustrated and emphasized the importance of having your CPA and financial planning consultant work together on the same team and in harmony while executing strategies developed for your unique situation. We believe our approach integrates individual, financial, and business tax planning holistically, and that these important strategies should be implemented in harmony together. The team at Coker James is always ready and here for you. Please contact us today to discuss your specific year-end strategies. Again, thank you for joining us, and have a great day.